Greetings, everybody. This is Jeff Scott. It is January 10th, 2016. This is my weekend review. Please note, I apologize if there's any issues with sound or clarity as I'm using a portable, as I'm not at my home base. I'm in San Francisco for the JP Morgan Healthcare Conference. I titled today, A Bear Too Far. What do I mean by that? We are really oversold. And I'll show you some numbers that suggest that we are at as far as as oversold as we get under normal circumstances, and that might suggest that we've got a bounce coming. Now, my daughter's boyfriend, and I actually got into a texting discussion about whether he thinks that when I say oversold, it's really when the fundamentalists are playing technicians looking for an excuse to buy things. And he's not a big believer, and he's works for the Lowry Group. I guess I can say that. I've been following their research for some time, even before my daughter met him. Actually, I sort of introduced him to the Lowry Group, and they hired him. A Bear Too Far is a takeoff of a movie from World War II called Bridge Too Far. And in A Bridge Too Far, it was an aborted attempt by Montgomery to go through, I guess, Holland and do an end around the German forces. And the end result was they went too far. And it failed because they went too far. Has this bear move been too much too fast? And are we likely to see some type of a correction in the bear or a oversold bounce? That's kind of the point, and we'll talk about that today. I almost put the saying from one of the Mel Gibson movies, I think it was Braveheart, when he's holding back his troops, that's an overstatement, and saying, hold, 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 telling don't jump yet, don't jump yet. And I think I should say the same thing here, because it's one thing to say we're deeply oversold and we're going to bounce. There's another thing to say wait until the bounce actually occurs, because you can get even more oversold. And let's begin. As always, this is for education purposes only. I'm a doctor, not a broker. I'm independent. Trading involves risk. You and you alone are solely responsible for any investment decisions you make. Any stocks I choose to talk about are, again, for education and not investment advice. I've done this slide so many times. Let me just say that I've married what I think is the best of Cancelim on the left with my favorite guru, John Person, from the perspective of actionable signals, philosophy of trading, and education of trading. And I had a little bit of Van Tharp for position size money management, and my buddy George Lee in Canada is someone who I've done some live programs with, and we talk frequently about the market. What I need at my desert isle, I've listed them here: TradeStation or Thinkorswim or both. Genesis is sort of a luxury. I think if I was on had a question of putting money into my account or buying software, I probably would not have Genesis, but I think it offers one of the most flexible and best charting packages. Frankly, all the pros use it, or many of the pros. For analysis, I use HGSI, EdgeRater. I do seasonality, and we may look at that tonight to talk about Netflix and how am I going to handle it, and then a number of websites. So I always start with the sector review for the prior week. I know you can't read it. I don't expect you to. And I could actually make that easier for you to see, perhaps, and pull it up in TradeStation itself. And I call it sector scan, and where is it where I want to go to? Well, actually, I must have, here it is. And as you can look at this, and it's not a full resolution for me, hard to see any place with a lot of strength. And so really it was a pretty bad week in the market. I think 6 or 7% down on most of the major indices. And as you could see, really a sea of red, and not even the safety of the utilities. So not a lot of places to hide this past week. You all know that, you're traders. Major markets told the story. This is the daily, and you could see going across the top the E-minis, the NQs, the YMs, the TFs, the VX, and the dollar, and you could see breaking down below the 50-day moving average on both the E-minis and the NASDAQs. You could see really diving on the YMs coming down towards the 200, and the TFs, or the Russell futures, already sitting on their 200-day moving average. Commensurate with that is a big spike in the VIX, and the dollar holding fairly steady. Notice this line here was a trend line that I've been looking at, and we actually knifed through this trend line across the board on Friday. If I look at weekly charts, for example, you can see, whoops, here's the weekly charts. Actually, my bad. These were the weekly charts here, which I just commented on breaking down. So it was not the 50 daily moving average, but the 50 weekly. And on the daily moving averages, you could see we've really fallen so hard that we've broken the 200-day moving average, smashed it here on the YMs and the TFs. So the question is, will we bounce from this area, or will we see the E-minis and the NASDAQs get to look as bad as the YM, the TFs, and we have a lot more bad to go? Notice on the VIX, we're kind of where we were the last couple of spikes during this year, and the dollar, as I said, kind of going sideways. So we'll talk more about some of my pivots, but I'm going to show you that not only are we oversold from many perspectives, but we're kind of coming close to our monthly pivot supports and what might be a obvious time to see bounces. These are quarterly pivot support, that's not monthly, but quarterly pivot support right here. And you notice on the E-minis on the daily, right on support. On the NQs, almost to support. TFs, YMs, NYC and YS, and the YMs. So the YMs, the NASDAQs, and the ESs are pretty much sitting right on quarterly support. Why is that important? Because if you follow John Person's pivot work, that might suggest that this might be another reason for expecting a bounce. Interest rates, to me at this point, it's not about the Fed raising rates as much as our perception of what the economy is. And even with the Fed raising rates in December, you notice the rates have continued to languish. And that languish in the rates has been accompanied by sort of a topping and falling in the S&P. So to me, this is a vote on concern about the economy, not rates going up because of the Fed. And I think this is weighing on the banks and other interest rate sensitive entities. Here's the AD line. On the left is weekly, on the right is daily. And superimposed, the AD lines in white, the spiders are in yellow. And you can see that if this was a stock, it's broken through the 17. It failed on a retest. And you could see the stock market and the AD line are tracking almost identical on the weekly. And on the daily, you get even a better picture of how it's breaking down. Sign of a weak market. If you look at the number of stocks above the 200-day and above the 40-day, and that you're just looking here at this white line, you could see we're getting to the point where over the last several years the market has usually bounced from. So more indications that we might be getting close to an oversold bounce. Now, last week I talked about the canaries. In fact, I pointed out that we had knifed through the 50-day moving average, and at best we were at a decision point: would we bounce or break through? We broke through hard, and you can see for the week the canaries were down for 5 days they were down 7.3%, which is a pretty big drop, and coming right down to the 200-day moving average. If the canaries don't jump there or bounce there, I mean, that says really bad things for the market. Now you notice this red line here, and you see it here. It's maroon here. These are what's called phoenixes. And phoenixes often occur as exuberance to the downside. And when I see a phoenix, they're the opposite of the green, which is the eureka. And they take into a number of things, such as the arms and trend. They suggest when you see one on a market that has been moving up, a phoenix would tell me that we're likely to be selling off. And this one here was pretty predictive of that. When you start to see a phoenix occurring after a sell-off, that might show a little bit of too much exuberance to the downside. Again, more evidence of a bounce. This gray bar here is called a bingo, and you could see that we actually saw a bingo in the August pullback. And a bingo is a baby's out with the bathwater's indicator. So we don't have a bingo here, which would make me feel more promising that we were going to bounce. But we are seeing a Phoenix. Now, the Phoenix, the Eureka are in the general market. They're calculated on the NYSE or the NASDAQ. Depending on settings, I use the NASDAQ. So last week I said FANG was at a crossroads, and I called out, this is Google, this is Amazon, both of them sitting above their 50. Facebook sitting on their 50, as was Netflix. And again, breaking down some of the canaries into the FANG and saying they very much were at a crossroads. Well, that was a week ago, and now what happened? We've broken through on on Google, on Amazon, Facebook, and even Netflix, which is a very strong seasonal period, is struggling to hold the 50. So again, if we don't see a move here quickly, we're probably going to be, looking at more damage in the broader markets. Now, the reason why I got talking about oversoldness with my daughter's boyfriend at Lowry is notice the separation between the selling pressure and the buying pressure is getting greater. You get a buy signal when the buying pressure crosses over the selling. And, we had a sell signal from Lowry come in the summertime, which in hindsight's looking pretty good. The sell signal will be right about up here. And they told us to stay out of the market, which has been a smart thing. But when is it too much of a separation? And does that play into the bounce? He didn't think so. He thought I was overreading it. But I am noticing how wide the spread is between the selling pressure and the buying pressure. Market thoughts, worst start to the year memory. I think it's the worst 4 days ever. Broad market sell-off, extremely oversold by most measures. FANG near life support. VIX is spiking. I talked about the Phoenix after the sell-off. EPS season is starting. Perhaps upside surprises may rescue us. And, part of me is very concerned because that failure to hold the bounce Friday after good China numbers and great employment numbers suggests to me that, as I said earlier, we may get even more oversold before we bounce. Problem with being this oversold, even though I saw a couple of great short candidates, I'm not sure I want to go short, especially at quarterly support. We talked about stock patterns are cyclical. I think we very quickly have made it down here. Now, I don't know if we're down here where my arrow is, or if we're just starting a deeper correction or bear market. But we're clearly are on the right side of fear. That tells me what I want to be doing. It means I've been buying bear call spreads, or selling bear call spreads, I should say. What does that mean? It means I sell a call and I buy a call that's out of the money above it. The market drops, it expires worthless. I put the premium in my pocket. I buy puts. I'm getting paid to make money if the market falls. That costs me money. I'm selling naked calls for many a risky strategy, but looking at calls that are way out of the money, putting their premium in my pocket. Now, as we get ready to bounce, I'll probably start to cover those calls. I'm shorting stock and I'm buying contra ETFs. Now, the minute I think we've hit a bottom, if we do hit a bottom and we start a leg up, I've got to stop that and start to look at the strategies over here. So to me, it's important to know what the market's doing because it's those strategies that the market dictates. Know your news and your earnings. Taking a quick look here. JOLTS, so job openings, initial claims, some energy stuff, PPI. Boy, it's still so low. To manufacturing capacity. I think now they're paying a lot of attention to indicators of production and productivity, and I think partly why we sold off on Friday was there were some industrial or inventory numbers that were not showing a booming economy. I think now we want to see beats in the numbers because the Fed's already started raising. We got to make sure the economy stays with it. A little bit of earnings, Alcoa is typically what they used to talk about as kicking off earnings seasons. I think it's a lot less important, but looks like Nordstrom's, JP Morgan. I don't think that's Nordstrom's, that's Nordson, I believe. But Ozark is a bank that I've been in and out of. Citi, a number of things will be coming out this week, so we'll start to see some clue from earnings. Agenda, I've gone through some introductory comments. We'll take a look at the market, some top-down, which is kind of depressing, some of the bottoms-up work, and then we'll talk about the chart of the week. Charts of the week are for education purposes only. I pick a stock. I give you the guidelines about how I'm going to play it. I usually take the trade so I don't forget it, and I talk about it, but I do this for education, not to show off, certainly not when they do poorly, and not so that you take the same trade. I looked at wage last week. I liked it because it was turning green up above, coming out of a squeeze, had some pocket pivots. I was very aware that it was probably going to face resistance at the 200-day moving average and be at risk of falling, and therefore I set a buy stop above that. So when I looked at it in the person's indicators, and in this white line here was my buy stop, my target, and my stop, looking at a 1-to-1 risk ratio. And what I typically do when I take these trades is I take half off at my target and let the rest run and raise my stop to break even. Well, this trade did not fill. You could see that that was the high, and we actually got a sell signal the next day. So my concern about the 200-day moving average held true, as well as a weak market. Again, just to point out that we do have a user group. If you like the stuff that I do, HGSI is a wonderful tool. Ron Brown takes HGSI and has really done some amazing, great stuff with volume price analysis, which has now been built into HGSI. I use HGSI, and then I combine it with John Person's work, and that's what the HGSI Pug Users Group is. So for you to really have value for it, you pretty much have to own both programs. There's no cost to be part of the group. There's no special committee to determine it. If you have both programs, please reach out to me by email, and we can get you in. You get some free scans. You get some education with John and some other goodies. All right. Close that down. Let's look at the market real quick. This is a series of things that I like to look at on the major indices and sometimes the various sectors to give me an idea of what the market is doing. So just to talk about what we're looking at here, daily, weekly, and monthly. The price colors is called the Elder Impulse Indicator. When I list the Elder, I think, well, what a great filter. If it's green, I could be going long or holding. If it's red, it tells me I shouldn't be going long. I could either be selling short or holding. If it's blue, it doesn't tell me anything. So I filter by color. The red and green arrows are person sell and buy signals. These dots here are the pivots. This is S1, this is S2, this is S1. Now in John's work, just to give you a little secret, I'm not going to tell you how he calculates it, if the blue is above the gold, his system is projecting a positive month. If you're expecting a positive month, then you shouldn't go below S1. This is S1, and you can see the NASDAQ has traded down to S1. This is a MACD histogram and MACD lines. This is the force, volume, and this is the high jump. We're going to ignore that for today. I quickly look at this. I see the NASDAQ red, red, red. Elder filter says sell or hold. It's in a sell signal by John on daily, weekly, and monthly. NASDAQ is very weak. On the other hand, it's sitting on support, which has me interested in expecting to see a bounce, but I don't know when that bounce is going to occur. I look at the Dow. Now, we may start to see some MACD divergent dots, and when I see that, I'll show you. Same thing, red, red, red. Daily sell, weekly sell, monthly still in a buy by John, but the Elder filter has gone to red. Now you notice on the Dow, blue is below gold, so he's calling for not a positive month. Interesting. Well, he's not calling, it's automated by the program. If I look at the S&P 500, broken record, red, 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 sell, sell, sell. I'm looking for my little divergence dots. I don't see them. If I look at the Russell, Look at the YM as the Russell surrogate. And what am I seeing? I'm seeing sell, sell, a buy on the monthly, and we see red throughout. Make sure I got my MACD histogram turned on. Yep, it's turned on. So, and then if I look at, I guess that's it. The Dow, the NASDAQ, the Russell, and what am I missing? The NASDAQ. NASDAQ, the Dow, the S&P, and the Russell. Now, we could look at stocks. I could look at the Qs, for example, for the NQs, and the same thing in a sell signal right on S1. If I look at the sectors, this is basic materials. Pretty ugly in a clear sell. Here's energy. Although it's been so weak, notice these green dots? These are saying that I've got MACD divergence. Take a look at my histogram here. Notice I've made a lower low in price, yet not a lower low on the MACD histogram. As I've learned that suggests to me we're getting to a point where we have less people selling and less selling pressure. We see that divergence both on the daily and on the weeklies. So that might be optimistic if you think energy is going to bounce here. Finances, they got killed this week, right down to S1, sell signals throughout. Industrials, down to S1, here is S2, and sell signals throughout. Technology, sell signal down to S1, has a buy on the monthly but sell throughout. Staples, utilities. You notice any patterns here? Everything is red. Now utilities are green, actually have a weekly buy signal, and they're blue on the monthly. Utilities therefore looking the strongest, which doesn't say good things ever about the stock market. Healthcare, nope. Red, 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 and clear sell signals. And lastly, discretionary. Knifing through S1, red, red, all sell signals. Hard to be excited by the long side on any of this because it all looks very bearish. Issue is, can it go down this much every day with no respite? Let's take a look at some of the indexes. Let's go to Woodward and Brown user groups. Again, calling out to Ian and Ron, these are things that they put in their update for us. They don't get paid by many of the users unless you subscribe to their newsletters or go to their live meetings. Just a labor of love, the HGSI community, so many people doing things to help other people. So these are 23 mixture of ETFs and major indexes, and they're being ranked by price and volume. The Friday being the most ranked, 3 weeks being the least, and a little bit contribution for the last week. And you can see over that period of time, things that are not correlated with a strong market, bonds, gold, volatility, utilities, commodities, and the dollar, silver, up. Then the big stocks, and then the weakness are the small and the mids. Biotech weak. So a bad week for stock investors. In fact, if you look at 5-day performance, you can see the VIX is up 48%. And the major markets, the Russell's down 7.9, the NASDAQ's down 7.3, the Dow's down 7.2, the S&P's down 6. That's as bad a week as I remember in the market. In fact, let me take a look at a couple other things. Remember, red is bad, black is good on this. You can see I only had 2 of my groups were actually positive for the week. Most of the groups I looked at were red, and I don't need to show you how bad those groups are. Just suffice it to say that my buy picks and the market all looked horrible for the week. There was no Hindi. The Hindenburg is a signal that's fired before major corrections. We can't get a signal when you have no new highs, and we have 0.5% new highs. We did have 15% new lows on the NYSE. Now it's gotten a little worse in the past, but that's a pretty big number, again, suggesting that we're probably near an oversold scenario. On the buckets, 92% of the S&P 1500 are below the midline, they're Bollinger Bands, and I think it's 56% are below their the 58% are below the lower Bollinger Band. Now I was curious, so I've got 20 years worth of data, or about 5,100 or so dates. And so I was just curious, where does this day fall in badness? So we're number 70 of 5,000 in regards to the percentage of stocks below the midline on the S&P. And if you look at, you have a lot of 08s and 09s here. You got August of 11, which was a bad time. So we're not quite the worst, but if you figure that in the last 20 years, there's only been 3 days a year on average that were more oversold than this day. To me, that's a pretty big number. How about the number of stocks below the Bollinger Band? So we were here as, actually, let me back up a second. Right, so this is extracted from here, so ignore that. But this was back in August when we had the deep sell-off in the market. That's the point of that arrows. The other question is, how important is those stocks below the lower band? And you could see it's the 12th worst out of over 5,000 days. So that means in 20 years, there's less than 1 day a year. And let's look at the dates. August of 2015, we were just a little bit worse. The rest are 2011 and 1998. Again, evidence that we are deeply oversold. The Woody market indicators solidly red, no shocker there. Now what's interesting and goes against this is seasonality. And there are a number of stocks that have a high percentage of being up this time of the year. This is a bullish sort on 1 month performance and a bearish sort. And very few stocks, interestingly, JetBlue is selling off and it makes the list, do poorly over the next month. So there's seasonality in favor of the market right now. The shorting, my shorting scan in EdgeRater, I got a lot of clues from that this week, which maybe we'll look at as well. All right, let's close that down. Now we'll go back to HGSI. Let's take a look at the S&P 500. So very quickly, I added this box recently. You could see that over the last year, last 12 months, we're down 6.8%. We were down 1.1% the last day and 6% for the last 5 days. We've had 2 recent phoenixes. We had a recent kahuna early in the week as well. We're solidly in the red on the bongos, which is my timing indicator, the weekly one. Now let's go to a cleaner view and talk about some of these charts. So here we are, 1, 2, 3, pause, 1, 2, 3. So we've had 6 days out of 7 with dramatic pullbacks in the market, with 1 pause day that really did nothing in between. Go back to August 24th, had 1, 2, 3, 4, 5. So we've actually had more down days in a row. If you go back through the chart, you don't see a whole lot of periods of time, late 2014, late 2015, and this week we have that many days. Now what's kind of worrisome is we've gone from a really nice run-up where we're almost constantly above the 200-day moving average to being solidly below, and that's a big change of character, and it'll be interesting to see if we can try and get back. If we stall at that 200 on the way up, you've got a great opportunity, I think, to make money in contras and shorting. Let's get the rebound first. That's the S&P 500. If we take a look at the Dow Jones Industrial Average, looks like the same thing, not much to say. If I take a look at the NASDAQ Composite, and if I look at the Russell, they all look equally as bad, as I showed you earlier. You want to see what looks good? Let's switch to the chart that will pop up some of my other indicators. Let's just take a look at gold. Notice Earlier in the week, you had a couple of kahunas on gold that actually sold off some on Friday. So let's go back into this. And you could see that gold, has gold found the bottom here? Maybe. Broke above the 50. I like to see it close and stay above the 200 before I want to get excited, because the gold has lived below the 200-day moving average going all the way back to 2014. How about silver? Again, decent day Thursday, gave back some on Friday. Must have been that employment number impacted there. Take a look at the dollar. Really going nowhere, sideways, but staying above its 200. And then the big mover of the week, the VIX. So before you go out and run and buy a bunch of VIX instruments, let me just show you what I'll just refer to as let the buyer beware. There is no question that this VIX is spiked. It's the same place it was in December. It has got a long ways to go to get where we were at in August. And notice that this is a single day where it ranged from about 41. Let's just see that. Let's look at that day. Close was at 40 and the high was at 53. So that was that's a 30% drop off the high of the day. These are incredibly tough to trade. When it's spiking like this, you don't want to be going long. When it starts to fall back, that's when you make money being long. When it's rising like this, going wrong is risky. So how can you play that? Well, how about VXX? And if you look at VXX as a stock, you see it's been in a downtrend and it broke above its recent high here. Let's put it in my usual stock scanning chart. So we have something that's been down 19% over the last year, up 23% in 5 days. It had a PSAR reversal, kahunas, relative strengths picking up, OBVs picking up, everything is green. If that was a stock, not a ETF index to volatility, I might be jumping on this. How about TVIX? Similar pattern, about to break above the 200, PSAR reversal, big kahuna, everything green. How about UVXY? Same thing. So why don't you want to go out and buy a ton of these? Notice this one was down 60, what did I do? Well, actually flat over the last year, which is kind of remarkable. But what I want to show you, that's my bad, it's no longer UVXY. Hold on. It's down 64% over the past year. Let's look at a weekly on UVXY. What does this picture tell you? This picture tells you that this is a sucker's instrument. How about the VXX? Just as bad. Look at these numbers. It was $8,000 a share. Now it's down to $21, $25. How about TVIX? This one was as high as 11,000, and now it's down to about 8. So how do you go from 11,000 to 8? These guys do constant reverse splits. What this does is it reduces the supply, it raises the dollar value of the instrument, and it keeps people engaged. These are long-term sucker bets, okay? Long-term sucker bets. Why would you want to buy one of these? You buy them short-term because you believe that short-term that these things are going to go up. So let's go back to TradeStation. And let me just put in, see if that'll work. See if I can remember what. All right. Here's the VIX on TradeStation. Green, green, and green. Buy signal, and you know what? What did it just take out here? Just took out monthly resistance. Now, is resistance going to hold and it's going to fall back? I don't know. But right now, it's a strong buy. You just got to be very careful with these guys because as over the long term, they do not make great trading instruments. Sure hope this is recording. Yeah, it's recording. All right. So I've been pretty bearish. Let's get even worse. Let's take a look at the industry groups. Let's look at, these are the only ones showing positive force over the last 5 days. Coal operations, these are two, I'm going to call them aberrations. These look like the VIX, solid downtrend, and I think the reason why they've been showing up here, this guy pays a 20% dividend if you actually believe your coal company is going to be here. This is 68% drop over 2 years. It was up 2%, over 12 months, up 2% the last day. Consolidated Energy, small dividend, down 75% over the year. Why is it making the list? Because it was up 5.8% on Friday, which is the big indicator. I would say one thing about that group, no thanks. Power generators. There might be some of these utilities that look interesting. 8-point pullback, looks like it wants to move up. Pays a 5% dividend. Talon, looks like a coal company, no dividend. Calpine pays a no dividend. Dynegy, no dividend. NRG, a 5% dividend. So these look like they're bouncing off the bottom. They're good dividend plays. I look at a 5% dividend. The stock lost 60% last year. That dividend didn't help me. Probably not interested. I'm probably going to pass on this group. And then the MLPs, the same story as the last couple. Now here's one that actually did interest me a little bit. This is NGL Energy Partners. It pays a 19.3% dividend. Stock is $14 or less, 20, so it needs $2.80 of earnings to pay the dividend. That worries me. I don't see that earnings here. On the other hand, it's probably coming off of a bottom here. It did have a kahuna starting to turn green up above. This one was a little bit intriguing, but it's been down 50% over the past year. It's up 20% the past 5 days, so this one is moving. Spectra Energy, similar looking chart. America, Spectra, what was there? Pays a 6% dividend. American Midstream Partners pays a 22% dividend, up 6.3% the last day. Ugly looking charts, awesome looking dividends. Dividends can go away. Kinder Morgan, 13%. So that was it on all the winners. So all right, well, let's broaden out my winners from 3 days, from 2 days to 5 days. This is over the last 5 days. And here's your gold. The only winners have been the gold on the 5-day period from a force index. And, American Barracks has moved off. Nice move up, a couple kahunas. Then a kahuna to the downside and a doji on Friday. 1% dividend, long downtrend. AEM actually broke above the 200, which is kind of exciting. A number of kahunas came in. Everything turned green here, 1.1% dividend. Not much in the way of earnings growth. The stock was actually up over the last 12 months, 5.5%. It's up 12% since the beginning of the year. If I had to buy one, that looks reasonable from a chart. AngloGold Ashanti, Gold Core. I kind of like the AEM because it's already broken above the 200-day moving average. Same thing with Franco-Nevada. So maybe you want to be nibbling in gold. That's it for the bulls. There is no other group that over the last 2 or 5 days of trading has shown enough strength that I would sit here and talk to you about it. What about to the bottom side? Now, the interesting thing is if I look at the 2 days, the last 2 days, gold, as I showed you the kahuna to the downside on Friday on the gold ETF, on a 2-day look-see, the only things that turned bad were the last 2 days were department stores So let's look at Macy's and Kohl's. And you could see they had a red candle day on Friday, lost 2.7%. Kohl's, also big down day. So these were the groups that were down on a 2-day window. Now the problem is we've been going down for 7 days, and you might need to broaden that, and I can look at 5 days down, and you could say I pick up a lot more groups that on a 5-day window have a negative force to the downside. So hard for me to get excited by this market to the upside. So what could you be playing? Let's look at the contra ETFs. Let me talk about these a little bit. All right. So those are the ultras. So here are the directions. The directions are a series of 3x ETFs. They're really good to play directionally at the start of a move. So, TZA. TZA has had a huge move. How many of your equities have done this over the last week? It's up 5% on Friday, 26% on the week, up 32% in the last 3 weeks. Wow, what a big move. Problem is, it's kind of like the VIX. It spikes and it comes right back down. In fact, as I was sitting on the plane flying out to California today, I was thinking to myself, maybe the right thing to do is to be selling some put spreads. So if I think the market's going to bounce, it's a risky play. Do I want to sell put, an at the money put? Or excuse me, at the money call, because that call will go to zero. Or do I want to buy a put here because I think it's coming down? That might be something to consider. Do I want to go long here? No, I wouldn't go long a stock here either because it's, odds are it's going to return to the mean. On the other hand, if I look at the TNA, which has always been a lot more expensive to play, the TNA had a bingo come in. Everything's red here. Now, it's not bouncing yet. It was still down 5% on Friday. But when I start to see that bingo, now I'm going to look for a bounce. And you could see, whoa, I got to stop doing that. You can see back here after the bingos, it started to move up again both times. So do I want to be buying TZA here? I guess I should say to you, I don't think so. I think it's a little late. What else could I be looking at? How about energy bear? Do I believe energy is going to continue to go down? I may. So I might look at this versus the energy bull. So these capture 3 times the move in your direction, and they're great, let me say it again, great instruments for short-term taking advantage of an aberration in the market. I think we're going to see a reversal to the upside. I don't know where that reversal is going to go. What I do know is that, I'm not used to this computer. I keep touching things and it moves. We got a ton of resistance in here. So what I'm going to look for is a move back up into this area of moving averages and then short breakdowns. You really don't, do we potentially drop down to test the August and September lows? Absolutely. And as I said, just because we're oversold, by no way means we're done selling off. But I think the risk to the downside and the risk to the upside are becoming more equal. And so it's probably the wrong time to just launch in and short the market. Now let's just go back out of curiosity. Let's look at 2008. And you would see, here's 07, and notice you had all the Hindis occurring then because you're in an uptrend at the top of the market. But 1, 2, 3, 4. And you saw 6 or 7 days down here. This is really an aberration, what we've seen the last couple of days. And this is what you're kind of looking for. I didn't even know what day I was going to find it. A breakdown, a failure at the 200, another run down. Shorted again here, and you didn't have to be knowing that's about breakdowns in the 200. You had, Hoffman has a name for these bars, but you had a shooting star at the 200-day moving average. Of course, that's high risk. Another great opportunity to short the market. I'm looking for that bounce back up to the 200-day moving average before I start going crazy on the shorting. Did I find anything of interest this week? Not much. Let's go through them. There's so few stocks. Actually, let me show you a couple other cool things. Let's go to all securities here, just to give you an idea of how bad this market is. And let's stick on the View HGS 100. Usually it's 105, 110 stocks. Only 16 stocks out of 8,400 made my screen for the HGS 100. How about sprinters? Technically strong stocks. Usually we get 30, 40, 50, 60, 70. Here we got a grand total of 26. And the piece de resistance, let me just limit this to $2.50 and 150,000 shares. Let's look at how many stocks have both a positive bongo daily and weekly. 8,800 potential, my all-time low now 138 stocks. That tells me that if I use the bongo daily and weekly as sort of my confirmed uptrend signal, I have only 138 stocks in my database that are actually in decent uptrends. Not a time to be overtly bullish in the market. But maybe, again, further evidence of being a little bit too far done. These are some of the stocks that made my list to watch this week, although I'm not going to give you a chart of the week because it's just the market's too crazy from my perspective. So let's just take a quick look and I'll tell you why I liked them. Bank of the Ozarks. No, I don't like this at all. What I like is the fact that it's a stock that's been in an uptrend for a long time. And it's pulling back to the 200-day moving average while in an uptrend. Last time it pulled back to the 200-day moving average, let's see if I can make that move a little bit. It bounced. So I'm looking for a potential bounce. Now, I'm not going to buy it until I see the bounce. So I'm going to look for a kahuna and a positive close. I'm going to look for a high close doji. I'm going to look for a person buy signal. But I'm going to put this on my watch list because I think it's going to bounce. Bed Bath & Beyond. I put this here mostly. I like the stores. Unlike John, he doesn't listen to my videos, so it's okay for me to say that. He doesn't. I do. I think it's overdone. This is sort of my bottom fishing special that I'm just going to watch and look for signals. Right now, I'm not going to touch it, but give me a kahuna, give me a pocket pivot, give me some Bible gap ups, and I might get interested. Do I like the stock now? No. I like the store, so I want to see if the stock ever decides to catch up. Sort of a more bullish play, Brachem, BAK, a diversified chemical. Broke out above the 200 here. Nice uptrend sideways to the 50. Had a kahuna earlier in the week. Even with a lousy week, the stock held up pretty well. Stocks that, to me, lead in a horrible week sometimes lead going forward. So I'm going to put this on my watch list and consider this stock. CDW Corp, I'm going to put in the same category as Bank of the Ozarks. This has been a nice performer in a steady uptrend since coming out as a public offering. It was down 6% on the week. Pulling back to the 200-day, I'm going to look for a bounce here. I'm not going to buy it until I see a bounce, a convincing bounce. Comfort Systems, same story. It had the bounce. This is a high close doji. I'm interested in this. Let's take a look at it on the weekly. And you can see it sold off pretty hard after being a nice uptrend. I like Comfort Systems. It's got good earnings per share growth. It pulled back to major support at the 200, was actually up nearly 5% in a bad tape on Friday. CubeSmart, this is sort of the perfect looking stock pattern over the last several months. Nice uptrend. It's up the last 3 months 13%, 26 in the last 6. Lower left, upper right, starting in September. Great earnings per share growth, pays a 2.7% dividend. Even though I just bought a house, I had to go rent a storage bin because my wife won't let me bring my baseball cards in the house anymore. And for those of you that have baseball cards and are currently laughing at me, when my son was born, I thought back to when I went to college. My mother threw out all my baseball cards, and I was going to be better than her. So I collected baseball cards and have every baseball card by every manufacturer from about 1963 to 2003, when at the age of 15, my son told me that he has no interest in my baseball cards and he never will want them. So now I'm holding out to grandkids, and every time I move, which has been 8 times since, I carry them with me. My wife is sort of mad at me about that. Long story, but baseball cards are a bad investment. Cube looks pretty darn good. Cyrus One, this is another REIT that I've been in. They do a lot of the technology-based infrastructure. It's got to sort itself out here. It's pulling back, but I'm going to see if I can't pick it off close to the 50 where it's bounced from in the past. Look at this earnings per share growth coming in. It pays a 3.4% dividend. Digital Realty Trust, it's in the same basic business, a lot nicer looking technically, and a nice uptrend, a bunch of pocket pivots, great earnings per share growth, 4.4% dividend. Dycom, another stock that sort of reminds me of Fix in that it pulled all the way back to its 200, had 2 dojis in a row, a high closed doji here, a PSAR reversal. I like this one. Actually, I bought some off the 200-day moving average. Now, I bought it because it bounced off the 200 here with the high closed doji. My stop, I won't let it get below the bottom of that doji bar. Great earnings per share growth. This has been an IBD 50 stock. HRT, kind of like CubeSmart, a nice dividend-paying REIT that's in a nice uptrend. Health Equity, bottom fishing. This is they run healthcare facilities. Don't know much about them. Horrible downtrend. It doesn't pay a dividend. On the other hand, if you look at this on a weekly perspective, you can see it was in a big uptrend from an IPO, then sold off hard. Why do I put this on my watch list? No, I'm not going out and buying that tomorrow, but it had a doji and a bingo here. If I get a close above the top of that doji bar in the next 3 days, that's a high close doji, I might start sniffing around. I like the earnings per share growth. HII, they make aircraft carriers. I should have picked this as my stock of the week last week. It was actually up on the week. Struggling at its 50-day moving average. Kahuna's. I like the company. They've got some recent contracts. Again, none of these are great charts. JetBlue, no, I'm not interested in buying JetBlue. I put this here to point out you can't stay married to these things for too long. The stock is broken. Now, it did have a bingo, so maybe it has a reversal and goes back up from here, but this is deeply sold. MaxLinear, a technology play, big run-up, crashed pretty hard, actually had a bingo, and then the next day they came out and raised guidance. Had a kahuna here, struggling to get above the 50. Break above the 50 and close above the 50. I might want to be thinking about this if the market calms down. Great earnings per share growth. We already looked at NGL Partners, a 20% dividend payer. This is a biotech that I don't know anything about, except you got to love the pattern. Sideways, move up, sideways, catch up to the moving average, move up, sideways. Just a pattern I like to nibble on. Do your research. It doesn't make any money. One of the best looking patterns, though, that I've shown you today, and it does have adequate volume. Pilgrim's Pride. This might be interesting, too. Everything is green here. Don't like the earnings per share growth. It did have a kahuna and a big up day and a bad tape, so now we have to look at info from Web. Why did we have a good day on Friday? Mr. Google FinViz, let's see what we get. We get the answer of upgrade to hold on positive initiatives. Well, that doesn't sound real great, except you got to like the pattern here, closing above the 200 with the kahuna, relative strength improving, OBV crossing above its MA. This might be worth looking at more. Range Resources, put this on the bottom fishing. Is it done going down? I don't know, but it had a kahuna on Friday and a bad day. It's one of these great energy plays, and someday it'll probably even go up. Is it done going down? I don't know. If I was looking to nibble on some energy plays, this might be one I look at. This is one that was almost $100 a share, now down for about 24. Senior Housing Property Trust. I don't know why I picked this, except it's got a 10% dividend in an aging population, and it's up 6% in the last month. You know, I'd rather buy it above the 200-day moving average. I love that dividend. It's worth me watching. Sinclair, this and Starbucks are the same story to me. These have been big winners, big run-up, then sideways, now pulling back into support here. Would I buy it here? No, but I like the earnings per share growth coming. I like this company. It's at a point where I'm going to look for a reason to get into it. A bounce off of here might be interesting. Starbucks, even better. Here's another stock. This stock's got a better long-term uptrend. Pull back here. Now maybe it goes to that 50 weekly, or maybe it just bounces right off the 200-day moving average here. Now, this looks interesting right here on Thursday. Friday was sort of a down day, but this is another one I might be looking for a bounce. A close above the top of that doji in the next 2 bars would be a high close doji sitting at support. That might be an interesting thing on what has been and will probably continue to be a big winner. And then WebMD was the aberration of the week. It was up 6.6% in the last 5 days, really breaking out. Don't know why. Everything is green. Big volume came in, pocket pivots, kahunas, something to put on your watch list. So those are all the stocks that I found that were compelling for me to look at on Monday morning. And the vast majority of them, I said to you right off the bat that I probably wouldn't buy them right here. Now, I dumped that list into my trade station, and I ran through John's indicators, and these are the ones that stood out. Here's TVIX. All right, remember I said be careful? Be careful. I'm not advocating you go out and buy TVIX. If I could sit by my computer at the market tomorrow, it's breaking above the 200-day moving average. It's in a PPS daily buy. OBV is strong. Weekly OBV is turned up. High close doji on Friday. That's a very strong buy signal and a very reliable buy signal for me in the past. My concern is it's hard to play the TVIX unless you're sitting and can devote more attention than I can because I'm on the road this week. That NGL, that utility with the 20% dividend, had a high close doji and a weekly PPS, good OBV on daily and weekly, and a PPS signal on the daily with Bible Gap. Let's see. Bible Gap up, Mobo breakout. Bible Gap up, pocket pivots upside, Mobo breakout, coming out of a squeeze, PSAR is supportive, and a kahuna force. NGL might be the best looking of the charts we looked at. PPC is Pilgrim's Pride. High close doji on the daily and weekly buy signals. OBV is strong, coming out of a daily and weekly squeeze. I like that. This was that range. Resources. You see a weekly buy, daily buy. OBV starting to struggle to come up. I think this one's going to work out okay, but it's higher risk below the 50 and the 200-day moving average, so a lot of resistance. And then UVXY is just like TVIX. So what I will be doing is I'll be loading these into my trading screens. I'm on the West Coast, and so I'll be up early in the morning to see what the market's doing. And look, if the market's rallying, I may not be going long some of these volatility things. I might be looking at other strategies. So no chart of the week this week. This is going to be an interesting week, to say the least. Be careful. This is not a market to take crazy risks in. It's not a market without risk. And happy trading, and Happy New Year, everybody. And thank you, and good night. Oh, stop. I want to look quickly at Netflix. I'm getting a lot of questions about how I'm playing Netflix. On the crazy sell-off day in August, I took a fairly big position in Netflix. I gotta restart this. I took a fairly big position in Netflix at about $90 a share. I sold half of it in this run-up. I still am holding a fair amount. Let me show you what Netflix does this time of year. Now the problem with seasonality, it's really good until it stops working anymore. So let me do my updates here. Bear with me a second. Let's actually look at all the FANG stocks before we say goodbye. So let's start with Netflix. So what do you see with Netflix? You see these green bars, which tell me starting January 18th, 10 and 0, 10 out of the last 10 years was positive, average return of 30%. Do you want to take this trade? I do. That's why I'm in the stock. The concern is the stock's in a downtrend. And do you want to get in now, or do you want to wait until the days around the trade, around the move? Earnings are due here, it looks like, on the 19th. So let me see real quickly. Those who know me know I haven't met a program that I don't like. I own a lot of programs. The problem is I have met quite a few that I don't like. I own a lot more than I actually use. Oh, don't do that to me. I'll try this one more time. Sometimes with all the things I got running, I get errors like that. All right, not going to happen. All right, Netflix options are very expensive. These options will get even more expensive over the next week. What I'm likely to do is to sell calls against part of my position to buffer me if the stock trades down. And I'll sell calls that are out of the money. And, does Netflix go to 120, 130? I think that's possible. I think it's also possible that one of these years Netflix is going to drop on earnings. Last year it looked just like this, selling off. Let's see if I'm not sure how to do 1 year here. Let's see, data. Let's look at last year. You notice last year it was relatively flat and it took off. Last year was a great year for Netflix. White would be last year, 2015. All right, so Netflix. Let's look at Amazon. Its earnings are due January 29th. Interestingly, it's got bad seasonality right now, and therefore 6 and 4, so it's kind of 50-50. Its big seasonality comes in here in March when it's got 7 out of 10. How about Google? You know what? Probably not enough data, so let's look at Google. Not a good time for Google seasonality at all. And Amazon, Netflix, and then Facebook. Also a tough time for Facebook seasonality, although you don't have a lot of years of data for Facebook because it's a relatively new issue. Lastly, let's look at the calendar here. Let's say I want 90% wins, at least a 10% change, and I want there to be option value, so I'm going to put at least 10. And now I'm going to hit enter. Ooh, I should have put price too, but so these are some of the recommendations as we now go forward in the month of January. See if anything stands out. DRI. There you go. You want a good seasonality play? Let's take a look at Darden. Starting January 11th, the last year, it's been up 10 out of 10 years. Average return 11.5%. I could tell you that consumer staples and food companies will actually look pretty good compared to the rest of the market right now. You're going into a strong sweet spot for Darden, and it's in a nice uptrend, and you could be buying it off the lower channel. DRI, let's just stick this in TradeStation. Take a look at it. So what I'm going to do is I'm going to watch it, and I'd rather buy it when I get a PPS buy signal. So I'm going to add this to my of interest list, but clearly that's got some very nice looking seasonality right now. Anything else here that I want to look at? Priceline, look at that. So the hard part of Priceline is it's a lot like Netflix in that it's sort of in a downtrend. Starting January 15th, you got a very strong seasonal part of the year, up 10 out of 10, average return 16.9%. I know what Priceline looks like on the chart. It's not a pretty picture. So let's just pull that up real quick, and then I'll say goodbye afterwards. So you've had some bingos. Let's just think about this. It's projecting a 17% return. 17% on 1,100 is about $180, $200. $200 takes me up to about $1,370. So maybe I might want to look at buying some calls around here and selling some calls up here and trying to capture $100 of movement. I'm not going to tell you what to do. I'm just thinking out loud. The fact that I'm seeing that bingo tells me I'm probably getting to the point where Priceline's due to bounce as well. Options are expensive, so I was referring to an out of the money. It's projecting a potential for a 16 or 17% move, so I don't need to buy an in the money option. So something to think about. So what I just wanted to show you is that I use seasonality both to scan for high probability trades as well as to test current holdings. I mentioned Ozark. Well, what does actually Starbucks was one that I was interested in pulling down to the 50. So Starbucks may be in a rough time right now, but starting around February 1st, 8 out of 10 years positive seasonality. So sometimes the seasonality might increase my chances and increase my likelihood of taking the trade. And here's Ozark where the seasonality is negative and I might be less interested. So on that note, I think I'm going to say goodbye. I'd like to thank you all for putting up with me again. Hope you have a good week. Not a week to play hero and be trying to outguess the market. Wait till you see the market turn before you decide to go all in. And on that note, I'll say goodbye. Goodbye, everyone.